In this video, we're going to walk through calculating the financial ratios for LA Gear for years 1, 2, and 3. Let's begin with our return on equity and our return on assets. Recall return on simply means net income divided by something. So net income divided by equity for return on equity, net income divided by assets for return on assets. So let's begin by picking up net income for year 1. So equals, go to our income statement, click on year 1 net income of $22,000, and we wanted to divide that by equity. So we go over to our balance sheet, and then we click on total stockholders' equity of $44,000. For our return on assets, again, equals, go to our income statement, click on our net income, then divide by our total assets on our balance sheet of $132,000. So what does this mean? This means that we are generating 16 cents in assets, 16 cents in income for every dollar we have in assets. And we're generating 49 cents in net income for every dollar we have tied up in equity. And of course, we can copy those across and we can see how that's changed. And we know that we've become less profitable. And sure enough, now by year 3, we're only generating 8 cents in income for every dollar in assets. And we only have 15 cents in net income for every dollar we have invested in equity. Let's go ahead with our others. Our profit margin. This is also referred to often as return on sales, and it's simply again return on net income. So we're going to take our income statement, net income of $22,000, and divide it by sales of $223,000, and notice this down here, our profit margin in net income in year 1 from our common size income statement was 9.8%. It was 3.4% in year 3, and that's basically what we're calculating. We're just calculating it in a different location. So there was the 9.8% and our 3.47%. Let's calculate our operating profit margin. Our operating profit margin is simply equal to our operating income, or earnings before interest and taxes, which we've got a separate line here of $41,000, divided by sales of $223,000. And our gross margin is going to be our gross profit from our income statement in year 1 of $94,000, divided by sales of $223,000. So we've calculated our profitability ratios. Next thing we're going to calculate are our turnover or control ratios that measures our efficiency. Let's begin with our total asset turnover. Asset turnover was what? Sales divided by assets. So let's equals, go to our income statement, pick up our total sales for year 1, $223,000, divided by total assets for year 1 of $132,000. And in year 1, we were generating $1.69 in sales for every dollar we had in assets. By year 3, that improved to almost $2.50 in sales for every dollar in assets. So we've gotten more efficient at generating sales with our assets. The next question will be, well, why? What in particular? Was it due to improved fixed asset turnover, receivable turnover, inventory turnover, cash efficiency, cash turnover, or it could be all of those? Let's go ahead and calculate our fixed asset turnover. So again, we're going to want to take turnover is just sales divided by something. Sales on our income statement, year 1, $223,000, divided by net fixed assets for year 1 of $3,110. And you can see we are generating basically $71 or $72 in sales for every dollar we had tied up in fixed assets in year 1. And that has decreased to $38 in sales. So we've become somewhat less efficient. Although I must point out, we have very little in the way of fixed assets compared to our total assets. So most likely, we are outsourcing. We're not making our own shoes. We're having someone else do this, manufacture sales or our shoes for us. We're importing them and then just retailing them to customers. Let's go back to our ratios. How about receivables? Our receivable turnover is going to simply be equal to our sales, $223,000, divided by accounts receivable of $49,000. And our accounts receivable turnover, we're turning it over 4.5 times per year. Wow, we've improved that to 5.7 times per year. So what does that mean in terms of days? We're collecting our money faster, aren't we? So what we can do is we can take 365 days in a year, divide that by our turnover ratio. And if it was 4, that would mean we're roughly turning it over what? 365 divided by 4 would be roughly every 90 days, every 3 months. But in this case, we're at what? 80 days. And we've gotten more efficient. Our receivables are turning over faster. So we're going to see our collection period will decrease over this 3-year period. It was taking us on average 80 days. Again, some people paying faster, some slower, but on average 80 days. We've dropped that to 63 days. Inventory turnover. On its most basic form, again, turnover is simply sales divided by our assets. So we could go with sales and divide it by inventory on our balance sheet. And you will see sources or people who calculate it that way. Quite often, though, because cost of goods sold is more closely related to what we've paid for our inventory, a preferable measure is often using cost of goods sold scaled by inventory. So rather than sales, we're going to go to our income statement, pick up cost of goods sold, and divide that by inventory on our balance sheet. And we're turning our inventory over 1.94 times per year back in year 1, roughly twice a year. And that has improved 3.68. So we're turning our inventory over faster. And we can see that if we do a days calculation. We simply, again, take 365, divide it by, we're turning it roughly over twice a year. So about every 180 days back in the first year. And we've sped that up. And now we're turning it over in roughly every 99 or 100 days. We can also look at our days sales in cash. We could calculate something that's simply called cash turnover, but we typically don't talk about a cash turnover. If we did, it would simply be our sales on our income statement divided by the cash on our balance sheet. And so we would be turning our cash over roughly every 53 times a year. Well, what we really want to do is say, how many days is it taking us to turn over or collect our cash? So rather than a turnover, it's more of a days type of measurement. Here's our formula for doing it. But again, we can base it on our turnover ratio as well. So just like down here, we took 365 and divided it by turnover. Let's just do that here. Let's get our cash turnover back again. So again, it was equal to our income statement divided by our balance sheet. There's average daily sales in cash. And we're just going to go to the front of that and put in 365 divided by, and we're going to need to put parentheses around this entire denominator. And there's our days sales in cash. And we could have also taken cash divided by average daily sales. Essentially, that's what we did. So we had about 6 days in cash on hand before. And now, we almost ran out of cash in year 2. And now we only got 1.3 days worth of sales sitting around in cash, which is great from an efficiency perspective, but not so great from a liquidity perspective. All right, the last thing we're going to calculate, it's not really part of an asset turnover ratio, but we've talked about our cash conversion cycle. How many days do we have our money tied up in cash? And we said that was how long is it tied up in inventory? How long is it tied up in in receivables? And if we added those two together, we would say that it's roughly 269 days between when cash goes out the door and when cash comes in the door. But this would assume we paid cash for our inventory, and we don't. We buy things on credit. So we're going to calculate our accounts payable period in days. So we're going to take accounts payable and divide it by average daily cost of goods sold. So let's go to our balance sheet. Accounts payable, 7,748 divided by, we're going to make sure we use parentheses here. Parentheses, let's go to our income statement. Cost of goods sold was 129 divided by 365 days in a year. And it's roughly taking us 21 days to pay our vendors. So we're going to take our inventory and receivable periods in days and subtract from that our payable period, because we get to hold on to our cash for 21 more days. So it was taking us basically 247 days to convert a cash investment into sales back in year one. And we can see how that has changed by copying this entire column over. And now our cash conversion period, or the amount of days we have cash tied up, is 148 days. All right, last set of ratios we're going to take a look at are our leverage and liquidity ratios. We're going to begin with our asset to equity ratio. That's our measure of leverage. So equals, go to our balance sheet. Our assets in year one, 132,000. Our equity, 44,000. And we've got it. Our total liabilities to assets, let's go to our balance sheet, equals current liabilities. And if we had long-term liabilities, we'd want to add that in, but we just have current, divide by total equity. Up, supposed to be total assets. That's the formula for our next one. So we wanted assets on this one, 132. So we've got 66 cents in every dollar for every dollar in assets. And if we were to calculate our liabilities to equity, go to our balance sheet. Total liabilities, 87,000, again, because we don't have any long-term liabilities, divided by equity. And there is our liability to equity ratio. Next ratio we're going to calculate is our times interest earned ratio. It compares our earnings before interest and taxes, in other words, our operating profit, with our interest expense. The higher this ratio is, the easier it's going to be for us to meet our interest obligations. So equals, let's pick up our operating profit from our income statement and divide it by our interest expense. So back in year one, we had $10 in operating profit for every dollar of interest expense. That had dropped down to $3.77 in operating profit for every dollar in interest expense by the year three. And two reasons for that. One, our operating profit percentage has done what? It's gone down. We were making 18 cents profit for every dollar. Now we're at 7 cents. And also our interest expense as a percentage of sales has gone up. So those two factors account for our lower times interest earned ratio. Our current ratio is simply current assets. Let's go to our balance sheet. Current assets, 128, divided by current liabilities of 87. Our current ratio is 1.46. How has it changed? It's gone up to 2.14. So our liquidity from using our current ratio has improved slightly, hasn't it? Our asset test, that's our current assets minus inventory divided by current liabilities. The thought there being that if we did go bankrupt and someone took over all of our assets and a bank wanted to liquidate us, if we were having trouble selling our inventory, certainly they're going to have trouble selling our inventory. So they want to know what are really our very most liquid assets, which would be cash, receivables, things of that nature. How do they compare to our current liabilities? So equals, let's go to our balance sheet. Current assets, we've got 128,000 in total current assets. Let's subtract off our inventory. We've got, so 128,000 in current assets. If we exclude inventory, we would have 61,000 in current assets. How does that compare to our current liabilities? Let's go back to our balance sheet. We had current liabilities of 88,000, 87,000. So we've only got 70 cents in very, very liquid assets compared to our current liabilities, but that has improved somewhat over the last 3 years. Let's go ahead and copy over this entire column. And the last things we're going to look at, it's a measure called cash flow liquidity. So rather than just comparing current assets to current liabilities like we do in our current ratio, our cash flow liquidity ratio compares current assets, or rather our current cash, plus any cash that we expect to collect with our current liabilities. So in other words, what do we have in the way of cash today, plus what cash do we expect to generate over the coming year, and how does that compare to our current liabilities? Because we can have very little in the way of cash as long as we expect, big checks to come in the next day or so, or a week or so. So let's go ahead and calculate that. Cash flow liquidity equals, put in a parenthesis, let's go to our balance sheet. Total cash in year one, we're going to need to do this just for year two because we don't have year one cash flows. So year two cash is 353, plus how much cash came in year two. Let's go to our cash flow statement. Operating cash flows were, cash actually went out, didn't it? Not a good sign. Let's pick that up. And then we're going to divide that whole amount by our current liability of $98,335. And you can see we have a negative number. So we don't have enough cash to cover current liabilities, and the cash we're having come in isn't going to do it either. Let's calculate our cash flow margin. Again, margin was up here, net income divided by sales. Sales margin means just something divided by sales. So this is net profit divided by sales, operating profit divided by sales, gross profit divided by sales. So our cash flow margin is going to be our operating cash flows divided by sales. Okay, how much cash do we generate from every dollar in sales? So equals, let's go to our cash flow statement, 42, negative 42,000, divided by year two sales. And let's copy that across. So what does this negative mean here for our cash flow margin? Negative 6.9% means that it's costing us $1.06, close to $1.07 in cash to generate $1 in sales. In year three, it's taking us $1.04 in cash investment to generate $1 in sales. So we've got $1.04 going out in cash and $1 coming in. And of course, we can't keep that up for long.